Welcome to Fractal 2025. It's your lead trader, Matt Fractal. As you know, we get straight into these videos. Let's get it. So starting off, I'm going to start with this presentation. It's just a seasonal tendency presentation, and I wanted to go over what we should be looking for the first quarter of 2025, of Fractal 2025. As you can see, we have the US dollar index, the 33-year and a 15-year seasonal tendency, blue being 33 years and 15 being the red line. We like to see on these charts with the seasonal tendencies both of the lines moving in the same direction, giving us a stronger yield for price and where price should be going. So I can see the blue and the red line moving higher, even though we have a consolidation here from the beginning of January to about March. We should have a bullish stance on the dollar index. And then in March, we should come back to this chart and decipher if we will make a high or just a reversal in the market, obviously using price action itself. But keeping it quick and short, the dollar index usually sees a bullish seasonal tendency in the first quarter of the year. Going to the euro dollar, we have a 20 and a 15-year, same thing, but should be the opposite, obviously. With this being the euro, we should be looking for bearishness for the beginning of the year, the first 3 months, the first quarter. So as I can see, the blue being the 20 and the red being the 15-year, we have some consolidation, but overall we're going down from January into beginning of March, right? Next we have the pound, the British pound. We have a 40-year and a 15-year, which 40 years being more data. As you can see, the 40-year has a bearish stance off the rip of January going into March. But the new 15-year, we have an actual rally up into January, February, and then we get in line with the 40-year of the bearish move. So we're going to be looking for the pound to either be in consolidation because of this 40-year and 15-year divergence, the 40-year going down and the 15-year going up in January, then consolidating in February, and then should be going bearish into March. Stepping into gold, we have a 34-year and a 15-year. In the beginning of the year, we see that we have some bearishness in the beginning of January, and then we have a little bullish rise, but eventually having that higher high in February, creating the high, and then going bearish into March. So January, we should see either a consolidation to a slight bullish stance, but then leading with the foreign currencies as well, February to March bearish. So that was seasonal tendencies quickly. Now getting into the central bank currency rates, or I should say interest rates. We have the United States at a 4.5% interest rate. And let's go to, so you guys can write that down. United States, sorry, United States at the 4.5%. Then we have the United Kingdom, which is the UK, the BOE, the Bank of England. We have a 4.75% interest rate, which is higher than in the United States, which we're gonna have to write down this fact that the UK has a 0.25 basis points increase compared to the United States, which honestly should have a bullish stance on the BOE, which is the pound versus US dollar. So we need to write that down, even though we see that the pound is supposed to have a bearish stance with this interest rate being higher than the United States, it actually puts more yield on the United Kingdom, which makes it more bullish actually. And then we have our euro at a 3.15. So the euro dollar should actually be bearish because it has a lower interest rate than the United States. So will be watching for a maybe a bearish euro dollar or a consolidated euro dollar and then a slightly bullish pound dollar, even though the dollar itself is supposed to be bullish for the first quarter of the year, but it's only January. So that's what I had to show you guys for the interest rates. Remember, with interest rates, you want to have higher interest rates if you're looking for bullish pricing, because that shows investors that you're going to get more interest on your money if you invest into um, these specific these currencies, basically, in these central banks. So now going into the market, as we always do, since we're in a new quarter and it's 2025, we're going to be starting on this 3 month time frame, which is just a quarter. So we started in January 2nd, we open, and we should be ending right April. So January, February, March, 3 months, and then we start the new quarter in April 2025. Okay. So with that being said, this candle right here is going to form. See, look what just happened. We had a bearishness on the dollar index. This candle is going to be open for the next 2 months and 11 days. So we want to know what's going on with this 3 month candle, because most of our trades, well, all of our trades until April 1st will be in this 3 month candle. So I'm looking at prior price action and I see this up close candle, which is an order block. I want to draw out my radiance. I have the 50% right here, which is the mean threshold. I will draw that out as a resistance. So we have this resistance area that we traded up into. Boom. Above that also I see this rejection block as well that I would like to draw out. It's another bearish PD array that we can look for the upside. And then obviously the old high. Right? Now looking down, look, we have this low, high. No, we do not create a lower low. So this candle, this up close candle, is a mitigation block. It would be a breaker if we did take out this low. So something like, give me a second, something like this, low, high, lower low, and then we broke the high, right? This would be a breaker. But it didn't take the low, so we're looking at this as a mitigation block, the whole candle. So I'll draw this out here, right? Notice how price price actually traded into it, consolidated. We also have this imbalance here, so let's draw that out. All right. We have an imbalance here, and if I also get the consequent encroachment of this, we'll have it here. So notice how our levels are coming pretty easy. If I'm going too fast, just slow down the video. We're dropping a lot of videos this year, so get used to the speed. All right, so we have a imbalance and a mitigation block, and we stayed above it. So overall, we're still bullish on dollar. We didn't take out this low, so it's a low, high, failed to create a lower low. So then when we break it, we create a mitigation block. We mitigated it. We might have to come lower to get in to the 50% of this mitigation block, also filling in the full. If you guys can see, there's still some gap here, so I can draw that as well. There's still some gap here, right, to be filled on dollar. So yes, we have bullish seasonal tendencies. Let me make this bigger. We have, yes, we have bullish seasonal tendencies. So yeah, we're looking for a bullish dollar, but we also have this imbalance that still needs to be filled technically. So we can see a down move for the first month or two and then continue, or we can pick up buying from this order block here, right? So price open, trade down, order block, and then continue higher into this order rejection block, and eventually the old high. But on the premium side, we see that this order block, the 50% mean threshold, is being absorbed right now, and price just turned bearish on the candle for the 3 months. So that was a lot for just the 3 month time frame. Let's go into the monthly. Monthly is just a little more spread out, right? We have our mitigation block here, imbalance. Notice how the imbalance on a 3 month time frame, the high is here, which kind of falls inside of this these three down close candles, which is an order block. But we also have the opening of these three down close candles consecutive right here as the open of the order block. I would like to draw out this opening, well, not opening, the high of the fair value gap on a monthly, because that makes it more precise. As you see, we had the fair value gap, price traded higher. We came into it, we couldn't close above it, well, we couldn't close below it, only wicking through. We had one close up below here, another close below here, but then we had a rally above old highs, which is a breaking structure, right? Also, if I take this level and just configure it up into this gap here, you'll notice we have a nice form fit of that. So this right here is supposed to be the mean threshold of that order block. But now on a monthly, we have just the order block here. We can refine it even more with this specific price point of this fair value gap, which we trade into it uh, this month, January. Boom. So we had an open trade up into order block, but more importantly, the high of the fair value gap. And now potentially we have a high of the month situation going on to trade back lower, either to pick up buying on this order block, this high end of the fair value gap on a 3 month time frame, or we're going to take these lows and fill in this gap, right, that we still have uh, fair value to take. So going into a weekly time frame, right, we have these levels posted up in our chart. We have a range as well. What's the range, Fractal? This high and this low, we have a range, right? So if I grab a fib, we'll see where price lines up with. And as you see, price traded up into a premium price. Now, being in a premium and potentially the high of the month, right? We're on a weekly chart now. So now we can look for highs of the week to be formed. Okay? Highs of the week to be formed until we get down into these bullish levels, right? But if we continue bullish just on a daily time frame, we have to be aware of that as well. So getting deeper, right, to like more of the 20-day range concepts that I teach, keep these other levels on your chart because you're going to need it for a higher time frame perspective, a 3 month, a monthly, and now we're on a weekly chart. We're going to form fit our weekly levels. But as I must say, trading for this long, the daily chart is going to be our basically our day-to-day levels that we need to make sure that we have on the chart no matter what. Even if we don't do higher time frame analysis, which obviously you should. That's why I'm just going over this now, teaching you guys higher time frame is key. But when we get down to the daily time frame, we'll do our 20-day look back, and most of those levels inside of the 20-day look back is what we're mainly capitalizing off of and looking for levels in high of the week phenomenon and low of the week phenomenon. Okay, so we have this weekly chart here. What I see, we can trade up into this order block here, but the reason why I don't like it is because the order block hasn't been broken yet. So I'm actually going to delete that and use the rejection block here. That's the most valid one for me on the higher, on the premium side. So we trade up into the rejection block. We don't take out last week's high, and we could potentially see a fall off, right? On the lower time, on the discount side, we have this order block here that we must draw out. It's too clean. This price point here can we can open, trade down into this down close candle, and then continue higher without having to come down into deeper discount, right? And then we look for the rejection block and then obviously the old high. Cool. So on a monthly, doesn't really seem too many levels. We have this fair value gap, but it lines up perfectly with the order block. So me personally, I'm gonna just take that off, and then we're gonna go down to a daily time frame. Okay, with the daily time frame, we have that weekly rejection block here, right? And we have that weekly order block here. Notice how we did break below this order block here, right here. We broke it, and then we traded up into it on Friday. So this was a resistance. Price traded up, boom, and then we had this gap right here, this huge gap. I know there was the government and the president had meetings today with the inauguration and everything. So we had this, little gap and all of that. This is why I don't really trade the first 2, 3 weeks of January. Sometimes you just have to take January off, especially during like an inauguration year, like a presidency year, and start your trading like February, second week of February. But I'm giving you guys this because we're getting to that time where active trading and smart money is stepping into the game. So I'm giving you guys an overview of what we should be looking for. All right, so let's do the daily 20-day look back. Um, I would have to back out of this and grab this tool. So we start on the day that we're looking at. So today is the 20th, but the Tuesday candle is still trading, so it's basically in the future, 21st. So now we look back 20 days. Don't get messed up with the 33 days that it says right here. We're looking at 20 bars. 20 bars, which is 20 days. They try to mess you up with the Sundays and the Saturdays, but we're looking at 20 bars, which is 20 days is here. And then I'll grab the low of that and the high, and then go back into full screen. So as I told you, yes, we have these weekly, these 3 month, these monthly, the weekly, all of these levels just for a higher time frame analysis, right? We have this high to low. We are in a premium on a higher time frame. Yes, we could come down, clear out these lows because they are kind of equal, fill in this gap here, and then continue higher, to take out this high for the rest of the year. But that's just over predicting, and we have to just lock in on the last 20 days of price, right? So we have a high and a low. You grab this tool that gives you your gradients, and you start grading your price swings. Or not your price swings, but grading your ranges. You have the 50% here, which is just the half point. This point, this 50% will give you the most clearest levels of discount and premium. I'll show you. And then using like the quarter points, will give you even a deeper discount, and I'll just add that for learning's sake. All right, boom. Okay, let's delete the actual tool, and now we have some levels for our chart. These levels, you can calibrate them to the nearest 5 or 0 levels. 5, 5, 80. Let's calculate this to 5, 35, and then this can be 175. So notice how we just ran up into this order block. This order block was formed above that 50% inside of this range from this low to this high. This is the 20-day look back. So this order block formed in a premium in the 20-day range was used for this move here. Trade up into it, and then we just had this down move. Where did price go down to just now to get this rally? We just traded into this this rejection block here. But this rejection block price is above this quarter point. If we wanted something more precise, we would look for something below in this quadrant right here, for something at a deep discount. And what I see already is if we get the 50% of the rejection block, which is the lowest down close to the low of the candle, and we move this down here, right, we have a perfect 50%, right? Boom. So price traded up into this order block, below this old low, into the rejection block, but we wanted a deeper discount. So where did we go? Obviously in the deep discount gradient, and it's a PD array. It's a 50% of the rejection block here. So boom, we opened here, and now we're trading up. So the next move for the dollar index, we would have to look at this up close candle now, right? So I'll draw that out as a resistance, as well as it formed above the 50%. So yes, it will be considered a clean premium price, and this can be potential to run lower if we're, well, I'm considering us bearish at this moment because of the higher time frame. I like this order block here for it to trade down into to create new buying, but until then, yeah, I'm looking for price just to be bearish on a dollar index, even though we have, right, a bullish stance on the dollar index. As you can see, before really like let's say the last week of February, or the second to last week of February, is where we actually get that rally. We get that consolidation, that bullish consolidation period from January and beginning of February. So yeah, we could go to an hourly. You can see how that would look. Right. Look at the levels. We have this order block. We traded up into it 1, 2, 3 times, and then we had that huge down move that just actually happened live. It went perfectly into a deeper discount, which was the 50% of the rejection block. So now we have this order block here above the 50%. If we get anything here and gives us a sell model to get into these prices down here, right, which is in balance on a 1 hourly chart, we'll look to pick up new buying here. But if not, and we break this with speed, then obviously we have levels that price could go down to. That's why we like to create all of our levels and put our PD arrays on the chart. So we're in line with the higher time frame, number one. And number two, it's easy for us to see where can price draw to. So now if we pick up some selling here, where's the easiest place for price to draw to? Oh, here. This gap, and this is a higher time frame level. So weekly order block. Cool. So one of my students wanted me to go over gold, so I'll throw gold in here for once. Let's go back to that seasonal tendency. Seasonal tendency for gold is kind of consolidated, but a little bullish stance in January, then bearish in February, March, right? So let's see if we can have any of that here. So on a 3-month time frame, the last 3 months, which was the fourth quarter of 2024, was pretty much indecisive, but on a bearish stance, right? We closed bearish, and it's hard to look back at any old data because we know that gold has been on the rise, um, like since its inception, right? So picking a top on gold would make no sense, but using either the last 3 months or the last 6 months of price can give us some telltale tell some telltale signs of where this 3-month candle might go or might do. So since we have no data to form fit any PD arrays on the left, we're just going to use the high of the last 3 months, or I would say the last quarter, the fourth quarter of 2024, and the low. That's what I would do, and that's what I'm going to do. Going down to the monthly, as you can see, 1, 2, 3, swing high, 1, 2, 3, swing low. So we're in between a swing high and a swing low. This swing high, as you guys know, is a buy side liquidity pool. This swing low is a sell side liquidity pool, meaning that there's active sellers down here that when price breaks through, sell side will be triggered. People will be selling. And vice versa, there's buy side liquidity up here. There's people with buy orders, either for a protective buy stop or a buy limit to when it hits here, they want to continue buying because they think it's going to go higher. So where is price coming from as well on this monthly time frame? Price is coming from, or price has entered into a fair value back in November 2024. So fair value giving sellers and buyers um, opportunity to get in the market at a fair value. But as I can see, price is staying above this fair value gap with its bodies. So that's already giving me a sign that gold still wants to go bullish. If we were bearish, we would be trading deeper into the fair value gap and closing in the fair value gap and then potentially using it as a inversion, right? So something like this, consolidate, and then breaking it and using it as an inversion to continue lower. But we're not having that. We're having something different. Price is not trying to close inside of this fair value gap. So with that being said, it looks like we have a bearish stance. Let's go to the weekly to get more information. All right, let's get into this price. So we have this weekly time frame. I'm going to start marking up these charts. Just watch and pay attention. We have a range of from this low to this high right here. Cool. And then we had deep discount. The reason why I'm calling this a deep discount is because if I grab this low to this high, fractal, why are you grabbing this low to this high? It's just a random range. No, we had a low, we broke structure here with this this swing high right here. We broke it and we continued higher. Then we had a retracement. So grabbing this low to the expanded high, right? It didn't just mess around. It went straight up after we broke the structure. Then we had a nice deep retracement, breaking it down all the way down to the 79% retracement level. Boom. So now if I have this range, I can draw to 50%. Anything below this 50% is discount. Everything above it is a premium. But if we're in this range from low to high, and we're continuing the fractal from this low to this high, now creates a buy model. Huh? Yes, you're learning something. In this fractal from low to high, it's like an optimal trade entry or just a regular Fibonacci retracement. If we're going back above this high, right, to continue it, because look at the bigger picture. If I grab this Fibonacci, right, we have this extension level here at negative 0.5, right? The reason why it's negative is because it's above the price. If you wanted something positive, it would be below. So when you're using expansion levels outside of the high, so from low to high, then we trade into a retracement level, and we're looking for an expansion levels. They have to be negative. Okay, just a quick pointer. Sorry. So we have an expansion level here, and I can configure this to 29. Let's just do 2946. Excuse me. So actually we'll do 2945, right? We have 2945 as a negative 0.5 expansion level. This down move here is now going to be the sell side of the curve. You'll see it on a smaller time frame, like maybe a daily. So we have the sell side of the curve, which traded down into a discount. Now going back up, we have the buy side of the curve trying to clear out, as I told you, this being the buy side liquidity with people willing, we have willing buyers up here. So price would want to see these willing buyers either get triggered in and continue back lower, or they will actually win this time and get triggered in as a buy and continue higher to 29.45 as a higher expansion level. So let's go to the daily, see this model if it plays out. So boom, we have this model right here. We trade low, high, lower, low. Now we have this potential buy model, right? From here to here. Not saying that it's going to be so clean, like just a straight down and straight up. As you can see, prices in the consolidation area. However, we're looking for that high. So what happened? Price traded up, came into this fair value gap. But notice how we didn't just strictly go for this low, since the higher time frame was still in that bullish buy model. It came down and it picked up more buying. Where? In fair value. Once here, take out this high, then a deeper discount, right, into this balance price range, but just deeper into the fair value. Take out some sell stops, which was here. sell stops, and now price is continuing higher. So what I can say for gold, we should be continuing to look at the bullish order flow, right? Until we have something more demanding on the bearishness. But right now, I don't see anything super demanding. I see bullish order flow being respected, right? This last down close candle right now is being respected just like every other down close. So now we can probably, our next move on gold would be this bullish rally to take out this old high back here. Then another rally to take out these old highs back here. And then eventually taking out the main high and seeing if we can run to an expansion level 29.45 for gold being bullish this year. Okay. However, if the dollar index starts to really rally in a bullish sense, then we would have to come back to gold and do more analysis to see if it would continue to rise with the dollar, which is usually not the case. Usually, when we're on a risk off scenario, which meaning the dollar is rising, it can be problematic for gold and foreign currencies like euro dollar and the cable. But on a risk off scenario, which is dollar going down, that's the best time to be in these foreign currencies and these commodities like gold, silver, copper. Okay, so I hope you guys learned a lot from this video. It's 2025, it's a new year, it's time to make money. It's not just a time to share analysis and be cool. We're actually trying to make money this year. So the analysis concepts are going to be even more deep and understanding. Thank you guys for everything, and I'll see you in the next video. Fractal out.